For us, there have been two main challenges in working with banks as a technology provider. The first is that we provide a horizontal technology that can be used in a variety of areas in the banks, whether in the front office sales and trading, traditional risk management, back office calculations. But that typically isn't how banks procure technology. They procure it along specific business lines, along specific business initiatives. And so one of the challenges for us has been working with the technologists inside the bank to help the business people understand just how transformative our technology can be in a way that is easy for them to then put into a procurement plan. But the second thing really affects any young fintech company that wants to sell into banks, and that's the issue of longevity and dealing with procurement. The simple fact is that you have to be able to show that you have the chance to be a long-term provider of technology, a long-term profitable, successful vendor for the banks in order for them to work with you. They make 5 to 10 year technology and procurement decisions. They expect the companies to be around a long time. And so one of the biggest hurdles that we've seen a lot of fintech firms or generic tech firms that want to sell into banks is getting over the hurdle where they can establish that they've been around long enough that they have a good chance of getting through to being a profitable, successful vendor for the banks. And only if you're able to do that are you able to get past the procurement departments, which end up being something that every fintech entrepreneur I've ever met with complains about all the time is, even getting the business to sign off, even getting the technologists to sign off, getting a deal past procurement is often more work than everything you did up until that point. I think banks need to work with innovators because the simple fact is that they can't do everything themselves. The market has changed dramatically since 2007 and 2008. Margins are never going back to the peak. Everyone is having an issue with return on equity at the current levels, and so they really need to restructure the way that they provide internal services to their own internal customers that help reduce the costs internally to help drive up margins. And the only way to do that is to work with outside firms that don't necessarily have the same legacy, don't necessarily have all of the same cost structures, and that are able to come in and provide transformative changes to the way the banks operate, as opposed to the incremental changes that I think a lot of banks went through in 2009 through 2011. I think virtually every industry trend at the moment is driven by regulation. One of the biggest regulatory changes that we're seeing in the capital market space is the Dodd-Frank and EMIR drive to central clearing of OTC derivatives. Now, up until earlier this year, that was limited to house account. It was just the large investment banks trades with each other that had to go onto clearinghouses. But now the push for central clearing of client account trades is causing a massive change in every bank that deals in OTC derivatives, whether they're a futures commissions merchant or not. They have to incorporate the IM and VM methodologies and the counterparty-specific pricing in the front office. They have to be able to handle the IM and VM calculations and the charge-through in their FCM and prime brokerage business, and their entire collateralization procedures have to be changed to understand exactly how they're going to apply this in a world of central clearing of OTC derivatives rather than bilateral clearing. And in fact, we're seeing trends such as the ISDA and IOSCO efforts to even bring in standardized bilateral margin calculations for bilateral clearing. So I think regulations are driving all of the major drivers for change that we're seeing, but there are very specific ones that are very relevant from a capital markets perspective right now.